Hi, everyone. Hey, guys. What's going on? How are you?
Awesome.
Tom, Carlos, Adrian,
All good.
all good? Fantastic. We're going to let everyone get in comfortable and then we can get started. Welcome to our analyst call. So, guys, we have a special session today. We have our research team with me. We're going to recap what happened in the month. We're going to have multiple sections in this amazing call. I'm super excited to have Adrian, Tom, and Carlos here. We're going to talk about technical analysis. We're going to also walk you through the latest updates with the Shanghai upgrade. As you guys know, FM had its liquidity event, very similar to its IPO, where basically Ether finally has become liquid in the primary and secondary markets. And we're super excited to show you guys our dashboards and most importantly, the latest when it comes to withdrawals. And then most importantly, there is also some very exciting innovation in this space. We also want to show you the developments with scaling solutions where blockchains can finally process and settle thousands of transactions per second. So without further ado, Adrian, why don't you get started?
All right, let's start. I think it's good if we start with a little bit of a technical analysis just to get a feel where the price is today. So what we can see here is the Bitcoin price. We can see today and yesterday, we pumped quite significantly. So we have really big green candles. What's the exact reason? I'm not 100% sure, but I think a major catalyst could have been the ongoing banking crisis or banking turmoil in the US. We saw First Republic Bank. Their stock fell over 50% on Tuesday. I think as of today, they're down another 15% because they broke the news that over $100 billion in deposits have been withdrawn, which is insane. And therefore, obviously, they're struggling to survive at this point or looking for help and support. But this obviously, again, fits perfectly the narrative of Bitcoin as it has established itself as a neutral digital store of value. If we look at it, what happened the previous week, we can see from the beginning of the year, we broke those 200-day moving average, which is like this blue line over here, which is a significant level. We then went up to 25K, which was resistance. We got rejected here, retested the 200-day moving average, crushed the 25K, and are now struggling around this area between 28.5 to 30K where we have to break through. We can see here we got rejected quite significantly 10 days ago. The reason here is, in my opinion, I think we were definitely over leveraged. There was a bit too much euphoria in the market. Because if we look, for instance, at the Bitcoin liquidations, we can clearly see the amount of long liquidations. We had over 250 million of long liquidations, meaning a lot of people were betting Bitcoin to go up, but then we had a minor pullback and it came to a cascade of liquidations. If we look at Ethereum, obviously Ethereum had its major upgrade. We're going to get more news from Carlos and Tom in a second. A lot of people, we can see here, we had the Chapella or Shanghai upgrade on the 12th of April. A lot of people actually expected that there will be a massive selling pressure. But at the beginning, right after the upgrade, Ethereum did the exact opposite. A reason being could be that basically it removes uncertainty in the market. A successful implementation of the upgrade opens the doors for people that were a bit more risk averse. They want to wait how the upgrade goes. And now after it has been successfully implemented, they want to get back into it. What's really interesting to see as well, as you might know, a big problem in crypto is liquidity at the moment. Since we had the cutoff of Signature and Silvergate, which were essential parts of the traditional crypto infrastructure, because they acted as an on and off ramp for traditional institutional investors and crypto service companies. And since they have been shut off, we see a reduction in the spot volume. However, surprisingly or not surprisingly, we see an increase in the open interest of Ethereum options, for instance. Here on the right side, we see the CME Ethereum options on futures, and we can see here that it clearly goes up, meaning the demand for paper derivatives is increasing. And this could be an indication that overall there's still an increase in demand for those asset classes, especially Ethereum at this point. Why there's such an increase in Ethereum and what's going on in terms of the withdrawals, I think we have Tom and Carlos that are going to give some more details. Eli, you want to add something on that?
No, this is great, honestly. And it shows again that there is definitely more trades towards the futures market compared to the spot market. And that makes a lot of sense because the traded volume on the futures market, especially for Bitcoin and Ethereum, are usually by order of magnitudes larger than the spot market. And the rise of open interest is definitely an indication of that. What is important to note here is whether the positions are more long or short. So when we look at, for example, perpetual futures, which are basically similar futures contracts, but without an expiry date, usually the interest there is quite positive, which shows that basically the funding rates is more long compared to the shorts. And it shows again that the investors are expecting a higher price in the future for Bitcoin or Ethereum, and especially for Ethereum, given the fact that there has been a significant upgrade on the 12th of April. And then for Bitcoin, of course, the narrative towards the halving next year would be very important as well. And by the way, we have a real-time dashboard where you can see on Dune Analytics the expected date for the halving. But I think without further ado, and it's a good segue for what we can talk about when it comes to Ethereum, is that Carlos will walk you through some of the most important aspects to what we've seen with the Shanghai upgrade. Because there are two things, again, the Shanghai upgrade enabled the liquidity event for Ethereum. However, there are some limitations to get the Ethereum back. And that's why we built this real-time simulator so that you can see how much time, if you're staking Ether, you should wait in the queue right now. And again, to repeat, Ethereum has two layers on its blockchain. So there is basically the processing layer, which is more called the consensus layer. And then there is the settlement layer that is called the execution layer, right? So when we are looking into that, especially for the processing layer, there is a certain amount of Ether that Carlos is going to walk you through now, and that will reflect how much time the investor should wait to get their Ether back. Carlos, go ahead.
Perfect. Thank you for the intro, Eli. So as you may know, about 3 to 4 weeks ago, we released our Ethereum withdrawal simulator. And our Ethereum withdrawal simulator takes into account two main variables to estimate the amount of time it will take for investors to get their staked ETH back. And so just to give you a little bit of context, there is a maximum of 16 withdrawals every 12 seconds in the Ethereum network. And the Ethereum network also has a built-in bank run proof mechanism, which limits the number of full validators that can withdraw every 6 minutes. So about every 6 minutes, only 8 validators can fully withdraw their balance. So with this in mind, we took into account two main variables to estimate the amount of time it will take for Ethereum validators to get their ETH back. The first variable is the estimated full validator withdrawals. Right now, there are about 19,384 full validators waiting for full withdrawals. This is positive in my opinion, because this is even lower than our best case scenario when we released our Ethereum withdrawal simulator. And then as the second variable that we must take into account is the estimated missed blocks per day. Every block in Ethereum is a settlement. It's like a settlement time in the traditional finance. So every 12 seconds, we have a settlement in the Ethereum network. However, there are some instances where validators are not online or they don't take advantage of their designated block. So we can have some number of missed blocks per day. And before the Ethereum upgrade, we had mentioned that we had seen historically abnormal increases in the number of missed blocks around Ethereum network upgrades. And that's exactly what happened during the Shanghai upgrade. You can see that around April 12th, the number of missed blocks rose significantly above almost to 650 missed blocks. And so that's exactly what we have planned in our neutral and our worst case scenario. But now the number of missed blocks has come down to the average, if you will. And so with these variables in mind, the queue for full withdrawals right now is at about 11 days. So what that means is that to clear all full withdrawals, it will take about 11 days with the principle of first come, first served. That means that if you were first in line, you will potentially wait a little less. But if you're last in line, you will have to wait the full 11 days to get the withdrawals, whereas partial withdrawals will take about 5 days to clear.
And also the reason why there is a significant spike in the number of missed blocks is because many validators prefer to not validate the transactions when there is a significant upgrade in case there is a disruption or anomalies in the network. And that's why we're seeing that specifically here, of course. No, but this is great. Thank you so much, Carlos. And I think here, Tom, we would love to hear from you about what happened at the execution layer, because Carlos presented the processing transactions on Ethereum, and we know, of course, that these transactions are not yet settled. So what about the transactions that are about to be settled? What have we seen so far since the 12th of April? And it would be great that you zoom in some of these specific charts that you want to highlight for the audience here. Thank you so much, Carlos. Tom, this is your show.
And thanks, Ellie, and thanks, Carlos, for the overview on our amazing Ethereum simulator. So what has happened after the withdrawal enabled? As you guys might notice, Kraken is one of the entities that have a huge stake on the Ethereum 2.0. However, due to regulatory scrutiny, the SEC has decided that Kraken de-staking as a service program is a security, and therefore they can no longer serve this program to US citizens. And as a result, after the Shanghai upgrade has enabled withdrawals, we've seen that Kraken has been aggressively withdrawing their stake from the Ethereum network. So amount of full withdrawals, meaning that how much is the principal and plus the rewards is unstaked from the beacon chain. So as you can see, Kraken has withdrawn a huge amount. So if we go to an overview, a summary of the total sum, we can see that Kraken here, if we sort it out by the total ETH withdrawn, Kraken has withdrawn over around 600K Ethereum, which is worth around $1.1 billion. They have exited 15K validators from Ethereum, meaning that they no longer validate the network. However, does it mean that it will affect the security of Ethereum? It isn't necessary, because there are two push-pull effect, right? So when there are people withdrawing, in the meantime, there are also a lot of different entities staking on the Ethereum network. And interestingly, over the past week, we've seen that the last week has seen the most inflow since Genesis. So it is definitely a significant milestone for Ethereum, meaning that after the liquidity event has arrived, the risk of liquidity for staking on Ethereum, you don't need to wait for a long time in order to withdraw, right? And therefore, investors right now are more comfortable to stake on the Ethereum network. So last week, we have seen the largest inflow. And who are staking on Ethereum? So interestingly, we can break it down for you guys as well. So over the past month, over the past 30 days, of course, we've seen that the largest inflow is coming from Lido, which is currently the largest liquid staking protocol. So it makes sense, because if you have an option, people would usually prefer to stake it via Lido, because you can retain the liquidity to sell it or trade it in the open market. So that's the privilege. If you stake it through Lido, you can get a derivative token called stake ETH, so that you can still trade it on different decentralized exchange or even centralized exchanges. And in the meantime, we have seen that a lot of institutional grade staking providers like Stakefish, Stake.us, Kiln, Bitcoin Swiss, and Figment, we've seen that last week's inflow is actually driven by these institutional grading staking providers. It could mean that institutions now are entering the Ethereum staking business or activities, because right now they feel more comfortable staking their Ethereum on the network right now. And previously, a huge misconception is that when the Shanghai upgrade arrived, huge amounts of selling pressure will arrive for Ethereum. However, we obviously see that it doesn't happen, right? And in fact, the price goes up a little bit. And why is that the case? One of the key reasons is because, as Carlos mentioned, Ethereum has a really cool bank run proof mechanism. So not all validators can withdraw in the same time. They have to wait for a queue, so on and so forth. And in the meantime, we can also track the on-chain activities of the validators who withdrawn the Ethereum. So one of the key outflow is definitely going to centralized exchanges, but it doesn't mean that they're going to sell it on centralized exchange, because a huge part of the staked ETH is coming from centralized exchange. So it could be the centralized exchanges going to distribute the rewards or going to send the redemption back to the users. And in the meantime, we've seen that even though a lot of people withdraw from the staking business, but a lot of them actually restaked to the beacon chain, meaning that like around 14% of the withdrawn Ethereum actually go back and restake on the networks. It shows that the investors are actually long-term bullish or long-term believing in the network and want to maintain the security of the network. Ellie, Carlos, you guys have anything to add?
No, this is great, Tom. It would be great that you also maybe tell the investors what does it mean, because of course we've seen that the price decreased over the past 7 days for Ether, and now we're back to healthy levels compared to the past 2 weeks. When we're seeing these kind of withdrawals, what does it mean for the investors? Why should they care about it?
When you see a huge withdrawal, right, it could mean the business is trying to honor the redemption for the users. For example, Coinbase, Kraken, they do a lot of institutional grading staking services for the investors as well. Some institutional stake their Ethereum via Coinbase or Kraken. So it doesn't necessarily mean that the Ethereum is going to sell it via open market, but instead it will go back to the investors. They can have other options, either stake it, continue to stake it via Coinbase or other staking providers, which could instead earn them a higher yield. But of course, the investors that withdrawn from the Ethereum beacon chain can actually sell it on open market, and thus could contribute to a selling pressure in recent days as well. But we believe that the impact is not a huge impact in the past few days.
No, absolutely. And also, we've seen that there were many events, especially, for example, in the US. We've seen the crackdown on Kraken, where they had to shut down their staking as a service product for US customers. But of course, there was also the tax payment obligations in the US in mid-April as well, which also could reflect these withdrawals. But this is very helpful for the community and investors here and the audience to understand that some of these withdrawals are not always intended for specific selling pressure or selling points. It could also be to withdraw Ether from exchanges, given the fact that what happened with FTX, people want to use self-custody services and not using on exchange, probably using, for example, more institutional grade staking as a service products. As we've seen, for example, with stake.us and other institutional grade products that have more security measures and the avoidance of commingling of funds, as we've seen with FTX. So these are the things that could also reflect and indicate the withdrawals. I think it's a good segue to what we're seeing on top of Ethereum now, Tom, when it comes to the ZkEVM race, your fourth tab, I think, which is very exciting. So what we've seen here is that there is a rise and there is a new narrative for all the layers built on top of either Bitcoin or Ethereum. For Bitcoin, I'm sure many of you have heard of stacks and basically enabling smart contracts on Bitcoin. We're seeing the same as well for Ethereum. They're not, of course, these layers enabling smart contracts on top of Ethereum, but they're enabling faster transactions. And they are called layer 2s because the first layer is, of course, the settlement layer of Ethereum. So the layer 2s like Polygon and zkSync actually launched their scaling solution called Zero Knowledge Proofs EVM compatible. So in other words, ZkEVM. So Tom, why don't you walk us through some of the key data points here that investors should care about? Because layer 2s, again, is, I think, a significant narrative for how we can onboard billions of people on Web3 and crypto applications like decentralized exchanges or any other applications that we see right now in crypto. So tell us more about the differences between zkSync Era on the left and Polygon Hermez. There is a clear difference in their asset under management, or TVL, standing for total value locked. So tell us more about why we're seeing more, I would say, inflows into ZkEVM for zkSync on the left-hand side compared to Polygon.
Thanks, Ellie. So this is a really interesting analysis, I would say. So ZkEVM is definitely one of the most exciting narratives in the future, right? Last year, we've seen that layer 2 has started to heat up. A lot of users go to new layer 2s like Optimism, Arbitrum to try out their ecosystem, and it has been more mature than previously, and they have gained a huge traction in terms of TVL. So Arbitrum, for example, they have gained around 2 billion total value locked, and Optimism around 1 billion as well. So for Polygon and zkSync, it's still a long way to go, but then it hasn't been launched for a very long time. zkSync Era just launched during May, and Polygon ZkEVM as well. And therefore, for ZK Era's case, it has been a really fast adoption for their case. So after around 1 month, they already gained 253 million total value lock on the network. However, interestingly, for a similar technology, similar user experience, how come Polygon Hermez or Polygon ZkEVM is having much lower total value lock? So we are going to break it down to you later on. So in terms of the number of depositors, it's a much lower number as well. So why is that a huge difference here? So one of the key difference between zkSync Era and Polygon ZkEVM is that zkSync Era does not have a token yet, but they will be going to launch in the future. However, on the contrary, Polygon ZkEVM already has their own token called Matic. And for the gas token on their ZkEVM is still going to use ETH, the Ethereum token. And therefore, if users are going to anticipate an airdrop in the future, what they would choose is going to be zkSync Era instead of Polygon ZkEVM, because a lot of the activities, a lot of the projects in the crypto space is trying to decentralize their tokens by doing airdrops to the users, to the early adopters. However, for Polygon ZkEVM's case, they said that they won't be launching their own token just for the ZkEVM. And therefore, it could be a huge reason why there are much less users or much less depositors and much less TVL for Polygon ZkEVM compared to zkSync Era. And we could also wonder how many of the users on zkSync Era is organic activities and how many are not. So interestingly, if a normal analogy or normal assumption would be if a user is going to use the new ZkEVM layer 2, they would be tried out the original layer 2s like Arbitrum or Optimism, which has a longer history. However, interestingly, we've seen that a lot of the users that try out zkSync Era haven't used Arbitrum or Optimism previously. And compared to ZkEVM, the number is much less, which is around 10%, but for zkSync Era, it's around 33%. 33% of them haven't used any layer 2 before. And in the meantime, 44% of the depositors are new wallets, but then they created after zkSync Era launched. So it could be people spinning up new wallets to farm the airdrops on the network. And on the contrary, ZkEVM only has 14% of new wallets. So these are some important indicators to keep in mind that to gauge how organic is their activities in both network. And we also break it down to you on the usage. Have they used DEXs? Have they used NFT before? And the top depositors as well. And overall, it is a really exciting development, but we should bear in mind that in the crypto world, there are some inorganic activities, but it is good that everything in crypto world is transparent. We can analyze it through blockchain data. So that's one of the perks. And Lee, do you have anything to add?
No, this is great. And I think it's a good segue to the other part of innovation, which is very important to move the needle, which is regulation. And we have our very own Lina here that is going to tell us more about the expectations that we have, and especially what we have seen on the regulatory developments when it comes to the MiCA text that has been revised and accepted by the European Parliament, but also what we're seeing more broadly in the UK trying to become a crypto hub, and also alongside the US that has some, I think, friction to some extent, but hopefully it could be also an opportunity for the industry to come together in the US and build a significant product that would make a difference. But Lina, we would love to hear your thoughts on the regulatory development side of things.
Thanks, Ellie. Yeah, I have to say that MiCA is our superstar this month, and it has been for a while, ever since it was introduced in 2020, because MiCA is, I don't want to be redundant, but just to reiterate very quickly, MiCA is the landmark legislation for Europe. And some can even say that it could be the template legislation for crypto regulations around the world. There's been a call between the world leaders for the urgency of such a framework to unite all regulators around the world and have a final say on crypto assets. So I believe that MiCA is good enough to fill this shoes. Something else that happened as well that also makes us look at the US with a bit of concern is Hong Kong's ratification of crypto assets as digital property. This is great news because this is in line with the crypto community seeing crypto assets as, I know a lot of people hate saying that, but digital gold, it's a commodity. And that's something that most crypto users or the crypto community have consensus on. So these two, like MiCA and Hong Kong in this segment, shows us how the world is progressing in terms of mass adoption and adoption that works well with crypto assets. In the US, we're still fighting on jargons, whether it's a commodity, whether it's a security. We've seen Gary Gensler in the White House and how the conversation was going. So it shows that there's still some unclarity whether crypto asset is a security or is a commodity. And that shows that this conversation will be with us until there's a proper consensus that will unite both regulators and crypto companies like Coinbase, for example, who's actually suing the SEC. And that is a good development in terms of not because the SEC is the bad guy here, but that's because it's more of an escalation to what Coinbase believes in and what many crypto companies believe in terms of the ethos and the values of crypto assets and how they are meant to make lives easier, not trip people off, basically. And that's the argument Coinbase is trying to make. And talking about other jurisdictions that companies like Gemini and Kraken and Coinbase is actually looking into, not necessarily to relocate, but more of to dip their toes in the audience and capture this kind of traction, to capture this non-US user base. Last week, they sent a letter to the UK with some recommendations on how they can regulate the crypto industry. And they really talked about how the UK is growing into a crypto hub and how, although it's going through a difficult economic crisis, but that is still in line with cryptos and with crypto assets being adopted in the nation. So we're seeing an emergence of a crypto hub in the UK, as we've seen in Switzerland. And hopefully the world is going to come around.
No, of course. And I think when it comes to the US, it's definitely possible that we see the community being brought together and really trying to ask for regulatory clarity and making sure that there is some innovative products, despite, of course, the friction. And that has been the same as well. We've seen that as well with the crackdown in other places against crypto in China. And now we're seeing over countries like Hong Kong, European reopening again, as well as Japan. So of course, what we're seeing in the short run is not indicative of the long-term prospects and adoption for crypto assets. And of course, fundamentally, we are very bullish on the asset class and the innovation. And we can see that the pace of innovation is really at an all-time high. And there is a very interesting chart where it's plotting essentially the price of Ethereum on the first y-axis, and on the second axis, we have essentially the number of developers, and we can see that there is a drawdown in the price of Ethereum compared to the all-time high from November 2021, and then there is an outpace and an exponential growth of the number of developers, which shows again that despite the bear market, we've seen that there is some strong demand for building on Web3, learning new programming languages like Solidity and Rust. And these are the clear indication where the space is headed going forward. And that's really an amazing chart to definitely show. So now it's open to the questions for the audience. And we already have a question. And this is from an anonymous attendee. What do we prefer, commodity or security? I don't think we have specific preferences. I think it's more on a case-by-case basis. But Adrian, what do you think?
When it comes to Ethereum, the question is here, under which legislation does it run, right? If it would be considered security in the US, it would fall under the SEC. And I think the SEC, if it's under the SEC, that would create a massive amount of admin and compliance burdens. Therefore, on the other hand, if Ethereum would be considered a commodity, it would be under the CFTC. And therefore, it would be subject to way less regulatory requirements and therefore could benefit from a broader acceptance and usage.
No, I couldn't agree more for sure. Do we have any other questions? So this one is replied. Thank you so much for the question. I actually have a more broader question when it comes to what should we be expecting? Because every week we have our newsletter and we have a specific weekly calendar, but also we have a monthly calendar for our monthly reviews. What should we be expecting in the coming weeks? Any specific events that our audience and the investors should keep an eye on that you guys think is extremely important? It could be a test net or anything else for the investors to keep an eye on the future developments.
I would say that something to keep an eye on is Lido enabling withdrawals. So Lido is a liquid staking provider, which has the biggest market share of staked ETH with around 32% of total staked ETH. And they haven't enabled withdrawals yet because they are still in the testnet phase and they are still doing some auditing that will enable withdrawals. So they expect to enable withdrawals sometime in May. And so that's definitely an event we have to keep an eye on because it means that we could see increased outflows potentially in terms of staked ETH. It doesn't necessarily mean it will happen, but it's something that we definitely have to take into consideration.
No, I couldn't agree more for sure. And I think one of the things that to consider as well in this analysis is how many validators from the US or staking on Lido. And I think that's a very small amount of validators. The overarching majority is coming from Europe. There's also some places in Southeast Asia. So we could be expecting definitely more withdrawals, but does not necessarily mean that we're going to see larger withdrawals compared to what we've seen with Kraken, for example. But definitely keep an eye on around mid-May or the first 2 weeks of May. It's possible that we could see more withdrawals on that regard for sure. And then most importantly, the rise of institutional grade staking as well, as Tom mentioned previously, is something to keep an eye on. Great. Anything else, guys? This is a no, and we're almost at time already. Unless there is any closing thoughts, comments, or any other notes here, thank you so much for making the time and for this great session. I'm sure it has been highly appreciated. The audience, if you have any questions, feel free to reach out to us. You have our email address. Feel free to also check out our research page on 21shares.com/insights. We do have a lot of content on a weekly, monthly, and quarterly basis. And most importantly, stay tuned because we have some exciting content going forward as well. All right, guys, thank you so much and have a wonderful day.
Thank you. Bye.